We are obsessed with the idea that the world can be solved. From the moment we first learn to count, we are conditioned to believe that for every complex problem, there is a singular, mathematically precise answer. We look at the sprawling, chaotic machinery of the global economy, a multi-trillion-dollar web of trade, debt, speculation, and sweat, and we desperately want to believe that it is driven by logic. We want to believe that if we just find the right formula, if we build an algorithm fast enough or a spreadsheet complex enough, we can tame the beast. We want to believe that wealth is simply a matter of physics. But the economy is not physics. The economy is biology. It is a living, breathing, sweating, and often terrified organism. And the single greatest mistake that the smartest people in the history of finance consistently make is forgetting that their flawless, elegant mathematical models are predicting the behavior of flawed, messy, and deeply emotional human beings. Welcome back to the Market Parables. Today, we are not looking at how math can be used to win. We are looking at a much more dangerous phenomenon. We are exploring the precise moment when the greatest mathematical minds on the planet built an unsinkable ship, only to watch it get ripped apart by the most primal, unstoppable force in nature: human panic. This is the story of why the world's most sophisticated economic models consistently, violently, and predictably fail against basic human psychological instincts. To understand this paradox, we have to travel back to the mid-1990s to a firm called Long-Term Capital Management. If arrogance had a corporate headquarters, it was LTCM. This was not just a hedge fund. This was an assembly of absolute intellectual titans. On the board of directors sat Myron Scholes and Robert Merton. If those names don't sound familiar, you should know that they literally won the Nobel Memorial Prize in Economic Sciences for co-inventing a mathematical model that priced options. They cracked the code of the financial markets. They took the unpredictable chaos of trading and reduced it to a clean, elegant equation. Joining them were the brightest minds from Wall Street, former vice chairman of the Federal Reserve, and armies of PhDs. They were the smartest guys in every room they entered. Their strategy was brilliant in its complexity but simple in its philosophy. They looked for tiny, microscopic discrepancies in the prices of bonds across global markets. For example, if a 30-year Treasury bond was trading for a fraction of a cent less than a 29-year Treasury bond, their models indicated that eventually logic would prevail and the prices would converge. The math dictated that these two assets had to return to their historical relationship. Because the profit margins on these trades were microscopically thin, LTCM borrowed massive amounts of money to amplify their returns. They were using leverage ratios of 30 to 1. That means for every $1 they actually had, they borrowed $30 to gamble with. And for 4 glorious years, they were right. They didn't just beat the market, they humiliated it. They generated returns of 40% a year. They made billions of dollars, and the financial world bowed at their feet. They believed they had eliminated risk. Their computer models, processing mountains of historical data, calculated the probability of them losing all their money to be practically zero. It was an event so mathematically improbable that the universe would end before it happened. But their models made one fatal, catastrophic assumption. They assumed that the people buying and selling on the other side of their trades were rational. They assumed that when a price dropped, investors would look at the fundamental value, recognize a bargain, and buy. They assumed that human beings, when faced with financial pressure, would act like calculators. They forgot that human beings are primates wearing suits. They forgot that we are wired by evolution to run when the herd runs. The models could calculate the standard deviation of a bond yield, but they could not calculate the adrenaline rushing through a trader's veins. They could not calculate the fear of a portfolio manager who is watching his career evaporate in real time. Mathematics assumes a world of perfect equilibrium, where every action has an equal and opposite reaction. But psychology knows that human emotion does not operate on a bell curve. Human emotion is contagious. Fear is a virus. And when that virus infects the financial system, the math doesn't just bend, it breaks. The unraveling of long-term capital management did not begin with a miscalculation on a chalkboard in Connecticut. It began halfway across the world in the summer of 1998, when the government of Russia did something the geniuses' computers said was virtually impossible. They defaulted on their sovereign debt. A global superpower threw up its hands and said, "We cannot pay." In the sterile, vacuum-sealed environment of an economic model, a Russian default should only affect assets directly tied to Russia. The algorithms calculated the blast radius, isolated the damage, and concluded that LTCM's massive portfolio of European and American bonds was perfectly safe. But the models could not predict the psychological contagion that was about to rip through the global consciousness. When Russia defaulted, investors didn't sit down, run the numbers, and logically reallocate their portfolios. They panicked. A primal, visceral terror gripped Wall Street and financial capitals from London to Tokyo. The instinct for survival kicked in. It was a classic flight to quality. Investors suddenly didn't care about microscopic arbitrage opportunities or the historical convergence of bond yields. They just wanted cash. They wanted safety. They wanted out. Imagine being in a crowded theater when someone yells, "Fire!" It doesn't matter if you mathematically calculate that the exit doors are wide enough to accommodate everyone if they walk in an orderly single-file line. Logic is irrelevant in a stampede. The only thing that matters is the blinding urge to escape. That is exactly what happened to the financial markets. Everyone rushed for the exits at the same time. As the panic spread, the perfectly logical trades that LTCM had constructed began to behave entirely illogically. Instead of converging, the prices of their assets diverged wildly. The tiny discrepancies they had bet billions on suddenly turned into massive, gaping chasms. LTCM was bleeding hundreds of millions of dollars a day. And here is where the glitch in the human operating system truly destroyed the greatest economic model ever built: the paradox of irrational momentum. Basic supply and demand dictates that when the price of an item goes up, demand should go down. If apples cost $20 each, you buy fewer apples. But in the financial markets, human psychology creates a bizarre inversion of this rule. Because of greed and the fear of missing out, FOMO, people often buy more of an asset simply because its price is rising. They assume the rising price is proof of value rather than proof of a temporary mania. Conversely, when prices drop, people don't view it as a discount. They view it as a catastrophe. They sell because others are selling, creating a self-fulfilling prophecy of doom. The Nobel laureates at LTCM stared at their screens in disbelief. By every objective, historical, and mathematical metric, the assets they held were incredibly cheap. Any rational actor should be buying them. But there were no rational actors left. There were only terrified humans trying to save their own skins. The market was completely ignoring the math. The models screamed that a bounce back was inevitable. But John Maynard Keynes once famously warned, "The market can remain irrational longer than you can remain solvent." LTCM found out exactly what that meant. Their massive leverage, the 30-to-1 borrowed money that made them look like geniuses in a calm market, became an anchor dragging them to the bottom of the ocean in a storm. They were forced to sell their holdings into a plummeting market just to meet margin calls from the banks that had lent them the money. By doing so, they drove prices down even further, accelerating their own demise. They had mathematically proven that the Titanic couldn't sink, right up until the freezing water was rushing over the deck. In the end, the Federal Reserve had to orchestrate a multi-billion-dollar bailout, not to save the geniuses, but to save the global banking system from the black hole that the geniuses had created. The smartest guys in the room were annihilated not by a math error, but by human fear. The ashes of long-term capital management leave us with a profound, almost uncomfortable realization about the nature of wealth and success. If the brightest minds in the history of finance armed with supercomputers and Nobel Prizes could be entirely wiped out by a sudden shift in human emotion, what hope does the average person have? If the economic machine is so easily derailed by the ghosts of fear and greed, how do we ever truly build anything lasting? The answer lies in the exact opposite direction of complex mathematics. The answer lies in the quiet, unglamorous mastery of human psychology. It lies in what we can call the Janitor Lesson. Consider the story of Ronald Read. Ronald was a man who swept floors and pumped gas in Vermont for his entire life. He wore a coat held together by safety pins. He drove a modest, second-hand car. He never learned what a derivative was. He couldn't calculate an options pricing model if his life depended on it. Yet, when Ronald Read died, he shocked everyone by leaving behind an $8 million fortune. How did a janitor vastly outperform, over his lifetime, the proportional returns of the brightest financial minds on Wall Street? He did it because he unknowingly possessed the one thing that economic models cannot replicate: psychological discipline. Ronald Read didn't try to outsmart the market. He didn't use leverage to amplify his gains. He simply bought high-quality, dividend-paying companies and held on to them for decades. But the true secret to his success wasn't what he did. It was what he didn't do. When the market crashed, when the Russian default happened, when the dot-com bubble burst, when the 2008 financial crisis melted down the global economy, Ronald Read did not panic. He did not succumb to the biological urge to run with the herd. While hedge fund managers were screaming into telephones and liquidating billions of dollars in a frenzy of terror, Ronald Read was quietly sweeping floors, entirely unbothered by the chaos. He didn't need a mathematical model to tell him that panicking was a bad idea. He had patience. He had emotional regulation. This is the ultimate paradox of the financial world. We spend so much time worshiping the intellect. We build pedestals for the quantitative analysts and the algorithmic savants. We try to conquer the market by building better, faster, more complex systems. But the market isn't a math test. It's a mirror. It reflects our deepest insecurities, our most profound greed, and our most paralyzing fears. The models fail because they try to remove the human element from a system that is entirely constructed by human desire. The greatest investors in the world, the ones who survive across generations, are not those who have the best spreadsheets. They are those who have the strongest psychological fortitude. They understand that a model can tell you what a stock is worth, but only your own mind can stop you from selling it in a panic. They understand that you don't have to be a genius to build wealth. You just have to avoid being an idiot when everyone else is losing their minds. So, the next time you hear an expert on television confidently predicting the exact trajectory of the economy based on a proprietary, flawless algorithm, remember the ashes of long-term capital management. Remember the Nobel laureates who forgot they were human. And remember the janitor who understood that the ultimate key to conquering the market isn't found in a textbook. It's found in knowing yourself, mastering your emotions, and refusing to let the chaos of the crowd override the quiet discipline of your own mind. That is the true market parable.